Welcome to Blue Nile Tutorials. In today's session, we're diving into our fourth chapter, Income from Employment Accommodation. Employer-provided accommodation can be a valuable benefit, but it also comes with tax considerations that you need to understand. We'll break down the rules surrounding accommodation benefits, including when they are taxable, how the benefit is calculated, and any exceptions or reliefs that may apply. Whether you're an employee enjoying this perk or an employer offering it, this chapter will help you navigate the tax implications with ease. Let's make sense of it all. Grab your notes, and let's get started. Welcome to this video on income from employment, accommodation benefits. One of the larger computations to learn is how to deal with the situation where an employer provides the employee with accommodation of some type to live in, whether that be a flat, studio apartment, house, or a bungalow. There are many stages for us to look at, but first let's consider the idea of whether the accommodation is job-related or non-job related. These terms are not used in their everyday sense, but instead have a specific meaning for this part of UK tax legislation. There are certain advantages, which we'll look at later in this session, to accommodation qualifying as job-related for tax purposes. However, this will only be the case if certain conditions are met. The tax legislation says the conditions to meet are that it's necessary for the employee to live in a specific property to be able to properly perform their duties, or it's customary within the industry that the employee works for that accommodation is to be provided, or the accommodation is necessary as there is some special threat to the personal security of the employee as a result of their employment. Looking at the first two initially, as this is the most likely to be relevant, some good examples of situations where the accommodation would be job-related would be a housekeeper who works day and night, or a school caretaker who lives within the school grounds to patrol and keep the property safe 24 hours a day. The situation with the special threat element could perhaps apply to somebody working for a company which tests its products on animals, as there are activist groups who protest and rally against such activities. It's therefore relatively difficult to meet these conditions, and more likely that the accommodation should be treated as non-job related. We'll come back to look at how the calculations differ if the accommodation is to be treated as job related. Where the accommodation is non-job related, which is the more common situation, there are various stages to work through to calculate the value of the benefit which arises. We can start by thinking through a basic pro forma so that we can work through each line of this to see how to calculate the correct figures. We start with a basic charge. Perhaps include an additional charge. Perhaps include ancillary services, and then arrive at a total benefit. The basic charge is the easiest part to deal with. This is the higher of the annual value of the property, which would be given in the question, and the rent paid by the employer for the property. If the property is rented by the employer rather than owned by them, this will almost always be the higher figure. But if the employer owns the property rather than rents it, we'll use the annual value that's given to us. The additional charge, sometimes called the further or expensive property charge, will only apply in certain cases and can be quite complex to calculate. Firstly, we need to know when the charge applies. There will only be a further charge if the property originally cost the employer at least £75,000 to buy. The two key facts from this are, we always look back to the original purchase price to decide whether there should be a charge, and there can only be a charge if the property was purchased, i.e. is not being rented by the employer. Secondly, let's look at the formula to calculate the charge. X minus 75,000 multiplied by the official rate of interest. So the two elements to consider further are how we calculate X and what the official rate of interest is. For 2018-19, the official rate of interest is given as 2.5%, leaving us just X to work out. This is the most difficult part of the whole calculation. To determine X, we need to look at two parts. Part 1 is to decide whether to start with the original purchase price or the market value at the date the employee first moves into the property. This will depend upon the gap between the date of purchase and the date the employee moves into the property. If this gap is at least 6 years, we'll use the market value at the date the employee moves in. But if the gap is less than 6 years, we'll use the original purchase price. Part 2 is then to think about any capital improvements made to the property, which could include things like building extensions or conservatories. We're only interested in capital improvements, not just ordinary maintenance like decorating or gardening. The rule here is that we only add into X capital improvements completed before the start of the tax year that we're working on. To summarise, the value of X to put into our formula will be the original cost or market value at the date made available. Capital improvements completed before the start of the tax year. To arrive at the value to use in calculation. The final part of the calculation is to look at any ancillary services provided by the employer. So this is additional items or costs covered by the employer as well as merely providing the property for the employee to live in. There are 2 elements here to calculate if appropriate. The use of furniture, if paid for by the employer, and household running expenses. To calculate the value of using furniture owned and provided by the employer, we use the same basis as we would for any asset owned by the employer made available for use by the employee. This means we take 20% of the market value of the furniture when it was made available to the employee. The household running expenses are calculated based on exactly what the cost to the employer is, and could include things like the employer paying for gas, electric, water, or maybe even the council tax charges. Anything which the employee would normally pay for themselves in relation to their home, and instead is being paid for by the employer, are included here. That's all of the individual elements of the accommodation benefit which might need to be calculated. So when we get to this final stage, the last thing to check is whether we need to make any adjustment for those general principles we've looked at before. The accommodation benefit is time apportioned where the property is only available for part of the year. And we're allowed to deduct employee contributions from the value of the benefit, although this is most likely to be referred to as rent paid by the employee to the employer. We need to put all of this together into an example to see how it works properly. Brad was provided with a house by his employer on the 6th of April 2013, which was originally purchased by the employer on the 1st of June 2006 at a cost of $105,000. The market value of the house on the 6th of April 2013 was $155,000, and on the 6th of April 2018 it had increased to $200,000. The property has an annual value for tax purposes of $4,500. Brad's employers purchased furniture for the house on the 6th of April 2013 at a cost of £5,000 and paid for the conservatory to be added to the house on the 30th of June 2017 at a cost of £20,000. Brad pays the running costs for the house and pays rent to his employer of £100 per month. Calculate the total benefits arising as a result of this. Following the pro forma, we start with the basic charge. As Brad's employer owns the house, there's no rent paid, so the basic charge will be the £4,500 annual value of the house. We then need to consider whether a further charge applies. The employer did indeed pay more than £75,000 when they first purchased the house. They actually paid $105,000, so we do need to calculate a further charge. This is the difficult part now, to calculate the value of X to put into the further charge pro forma. We can use a timeline to help us here. Remember, we need to look at the date the property was originally purchased compared to the date it was made available to the employee. For Brad, the property in question was originally purchased on the 1st of June 2006, and he moved in on the 6th of April 2013. The gap between these dates is more than 6 years, so we'll start by using the market value at the date Brad moved in, so the 6th of April 2013. The next part is to consider capital improvements made to the property, which here would be the addition of the conservatory on the 30th of June 2017. As this is before the start of the 18-19 year, we do add this into the calculation of X. To summarise, we've decided that X would be the $155,000 value on the 6th of April 2013 and the $20,000 paid for the conservatory, so a total of £175,000. The further charge calculation will be 175 minus 75 multiplied by 2.5%, so £2,500. Finally, we need to look at the ancillary services. The employer paid for furniture for Brad to use, so this will result in a use of furniture benefit of 20% of £5,000, so £1,000. Brad pays for his own running costs, so there are no other items to consider in this case. Totaling these results, then we have the basic charge of £4,500, the further charge of £2,500, and the use of furniture valued at £1,000 to give a total of £8,000. Finally, we need to consider our general principles. Brad lives in the house for the whole of the 2018-19 tax year, so there's no time apportioning to be done. But he has paid rent to his employer of £100 per month, so we can reduce the benefit by £1,200 to leave a figure of £6,800 to be included as a final accommodation benefit in Brad's employment income. So to finish this session, we need to go back to where we started and consider job-related accommodation. If the accommodation qualifies as job-related, the basic and further charge do not apply. They are in fact exempt. The only potential benefit for job-related accommodation is in relation to the ancillary services, but even these are capped at a maximum of 10% of employment income. So if there were a potential ancillary services charge of £5,000, but the employee earns just £20,000 a year, the benefit would be restricted to £2,000, being 10% of £20,000.